The topic for the day is basic accounting concepts. Now see the definition of basic accounting concepts. The term accounting concepts refers to all those fundamental ideas, basic assumptions, working rules and the principles developed by the accounting profession from time to time with the motive of making accounting more useful as a business language and a tool for making comparison. Dear friends, various accountants have developed various fundamental principles from time to time. All these fundamental principles from the applicability point of view can be classified in a chart. Just have a view. These fundamental principles are business entity, money measurement, going concern, dual aspect, full disclosure, consistency, matching, conservatism, materiality, realization, accounting period, cost concept, objectivity concept. Now we will discuss all these concepts one by one. The first concept is business entity concept. It says the business and the other owners as separate entities. The books of accounts are maintained from point of view of the business and not that of the owner. The personal transactions, assets and liabilities of the owner are kept separate than that of the business. Come to the next. Money measurement concept. This concept assumes that monetary business transactions and events can be recorded in the books of accounts. The recording of transactions is to be kept in the monetary units, not in the physical units. We do not consider the changes in the value of money. So as you see, this concept is based on valuation of assets etc. in the terms of money. Just take an example. Suppose your business purchases land 2 acres, building containing 10 rooms, 10 chairs, 20 tables and 5 machineries. But as these have been expressed in different units, these cannot be clubbed into one to express the total value of fixed assets of the business. So for the purpose, we are required to convert all these values into a common currency. Say in India, rupees. Like land, say 20 lakhs, building, say 30 lakhs, machinery, say 10 lakhs, furniture, say rupees 50,000. So this way, total investment of the business in these fixed assets is 60 lakh 50,000. Now this is a very sound information about the fixed assets of the business. Come to the next. Going concern concept. This concept assumes that a business firm would continue to carry out its activities indefinitely. It would not be sold or liquidated in the near future. Suppose your business has acquired a machinery. Its value is rupees 2 lakhs and its economic life is say 10 years. In the absence of this concept, you will be charging the total value of asset to your revenue. Means on one hand, you will decrease the amount of profit and on the other hand, one important asset will be missing. So for the purpose, on the basis of this concept, the total value rupees 2 lakh will be divided in 10 years and only 1/10 portion, 20,000 will be treated as expenses and the remaining portion will be carried forward in the subsequent years because that is the value to be utilized in the subsequent years. Come to the next. The next concept is dual aspect concept. This concept says that each and every transaction has a twofold effect. Means at least 2 accounts are involved in it. It is the fundamental principles of accounting that provides basis for recording transactions in the books of accounts. It can be expressed as accounting equation: assets equal to capital plus liability. See the effect of these transactions. Suppose I have purchased furniture for rupees 50,000. In this transaction, two accounts will be affected. One is furniture account, other one is cash account. On one hand, furniture is coming into the business, so value will increase, and on the other hand, I am making the payment for furniture, so value of cash will decrease. It is full disclosure concept. It states that all the material and relevant facts concerning financial performance of an enterprise must be fully and completely disclosed in the financial statements. If any information or fact does not find place in the financial statements, it should be the part of accompanying notes. As a material fact, no information should be left undisclosed unless it is not obligatory by any law. Consistency concept. This concept states that for making the inter-period and inter-firm comparison of the financial statements, the uniform and consistent accounting principles and concepts should be followed over the period of time. Two types of comparison are required in a business. First one is inter-firm comparison. A business is required to compare its performance with the performance of other units in the same industry. Similarly, at times we compare periodically. Performance of the same business for one period is to be compared with the performance of the same business for other periods, so that we can take so many financial decisions. Next concept is matching concept. This concept emphasizes that while ascertaining profit or loss for an accounting period, the revenue earned should be compared with the expenses incurred in earning that revenue. Both the revenue and such expenses must belong to the same accounting period. Actual receiving of revenue in cash or payment of expenses in cash is immaterial. Rather, it is considered on accrual basis. Dear friends, under this concept, we are comparing the revenue we have earned and the expenses on earning such revenue. Take an example. Suppose we have to find out profit. Total amount of sales will be compared to cost of sales, not cost of production, because it is not necessary that whatever goods we have manufactured will be sold in the same accounting period. So whatever goods are left as unsold will be treated as stock, and we will consider for revenue purpose only the cost of goods sold. Next, conservatism or prudence. It provides that a conscious approach should be adopted so that the profits reflected by the financial statements are not overstated. Profits should be recorded only after its realization, but the losses should be recorded even if these are anticipated. In fact, it is a policy of playing safe, so that due to overstatement of profits, dividends may not be distributed out of capital. Materiality. This concept emphasizes that accounting should focus only on the materiality of the facts. Immaterial facts and information can be ignored. Any fact that influences the decision of the potential user of the statement is considered to be as material. As you know, we record the stock as asset, stock of raw material, stock of finished goods. But just take the example of stationery. Stationery is purchased in a particular year, but may or may not be consumed till the end of accounting period. Even then, it is treated as expense of the year in which it is purchased. If any stock is left, it is not treated as an asset. Obviously, stock of pen, stock of pencils, stock of slide rules, erasers cannot be considered as material stock. Friends, come to the next. Realization or revenue recognition concept. This concept suggests that revenue should be incorporated in the business records on the realization basis. Revenue is the gross inflow of cash arising from sales of goods, providing services, and by way of earning income as interest, dividend, etc. It is considered to be realized when a legal right to receive it arises. Next, accounting period concept. This concept refers to total span of time at the end of which the financial statements are prepared. Accounting period is the interval of time after which the performance of business is ascertained and the financial position is reflected. Normally, accounting period is of 1 year. I said normally it is of 1 year, but at times it may be of more than or less than 1 year. That means 12 months. Suppose I start my business on 1st of May 2011. Obviously, I will close my books of accounts on 31st March 2012. So in this way, my accounting period will be of just 11 months. But this will happen only in case of the first year. From next year onwards, this will remain from 1st April to the coming March 31st. Similarly, suppose I start my business on 20th of March 2011. It becomes immaterial if I close my books of accounts on 31st March 2011. Obviously, I will close my books of accounts on 31st March 2012. So this way, my accounting period will be of more than 12 months. Next, cost concept. This concept emphasizes on the recording of assets in the books of accounts at their cost price, which indicates the cost of acquisition, improvement, installment, and making assets ready to use. This is the last concept, objectivity concept. The concept of objectivity requires that the accounting transactions should be recorded following their objectivity with the books of accounts. All the transactions should be supported with the proper documentation.